Starting May 1st, well-qualified homebuyers with larger down payments are going to be penalized so that more high-risk homebuyers can get a mortgage. What could go wrong? Welcome back, everybody. As always, I am Bill Olson, your favorite YouTubing Charleston realtor. And that's right, starting on May 1st, higher risk borrowers are going to be subsidized by those with larger down payments and good credit. So today we're going to talk about exactly what that is, what it looks like, how I feel it's going to affect the real estate market, not just here in our Charleston market, but around the country. And stick around until the end because there might just be a way to reduce these fees. Full disclaimer, this is not a political video. These are just my observations on what is going on and how I feel it is going to affect the real estate market. If you would like to debate any of that, please do so down in the comments. Just be polite to each other. That is all I ask. So in a nutshell, here's what's going to happen on May 1st. There is a new federal rule that will force higher qualified home buyers to subsidize riskier home buyers by paying higher fees when getting a mortgage. So basically, buyers with over a 680 credit score are going to see a spike in their mortgage fees. And those that are putting 15 to 20% down will see the biggest spike. And these fees are called LLPAs, or loan level pricing adjustments, and they're very common. The fees are typically converted into percentage points to alter the borrower's mortgage rate. So under the revised LLPA pricing structure, a borrower with around a 740 credit score and 15 to 20% to put down on their home will face a 1% surcharge. Now, this could equate to about a 0.75% on their mortgage rate, which is up from the previous 0.25%. Now, to put this into monetary terms, you're looking at roughly $40 per month at 6% rate of a $400,000 loan, which is about $500 a year. Conversely, let's take someone with a 620 FICO credit score and only 5% or less to put down. This borrower would get a fee discount that could amount to about 0.4 to 0.5%. Now, of course, the fees will still be higher for these more higher risk buyers. This is just a way that they're saying to close that gap. At first glance, this seems like a typical Robin Hood scenario of robbing from the rich to give to the poor, but it's really not. It's actually more so robbing from the average American who was good with their finances to give to someone who just wasn't as good as their finances and needs a little help to get to where they should be to buy a house. Let's look at a lower market. I grew up in Youngstown, Ohio. The average cost of a home in Youngstown, Ohio is $49,000 and some change. So if you are buying a $50,000 home in Youngstown, Ohio, and you have $10,000 to put down and you have good credit. Now, do you consider yourself rich by any means? No, you're doing well. Now, you are also being penalized under this new rule. And that is why I feel that it is robbing from the average American just looking to buy a house that has put in a lot of hard work to raise their credit and save for that down payment. So what do I think the implications are in the real estate market with this? Well, I think there's a few things that are going to take place. And I'm going to use Charleston, where I am, as our example. Now, like many areas of the country, we are still extremely low on our inventory. As we've gone into spring, demand has been skyrocketing and we are seeing multiple offers come back again, something we haven't seen in a while. So instead of trying to build up this inventory and stabilize our market, we are throwing more buyers into this market, more higher risk buyers. And here's where the first issue comes with. Now, when supply is low and demand is high, and we're adding more demand, what's gonna happen? Well, prices are going to start skyrocketing again. And what happened last time when prices skyrocketed? So many people got priced out of the market. I mean, have we already forgotten what happened in 2020 through 2022? And on the other hand, a lot of this demand that we're adding, a lot of these buyers that we are adding are at a higher risk of not repaying their mortgage. Have we not learned anything about that? So we almost have like two snowball effects here. Now, on one side, we're adding all of this demand to a low supply and we're gonna skyrocket these prices. That's exactly what's going to happen. But then what happens when all of these people can't repay their mortgages? We're gonna snowball that foreclosure effect as well. So we're gonna ramp this up like a roller coaster and then it could just bring it crashing down to a halt. I don't think that will solve anything. I don't think any of this is going to solve anything, but if you're going to do something, I don't think everyone needs to be penalized. So is there a way around this? Really, the only way around this to not pay these additional fees is to just tank your credit and try and get it down to that 679 so that you get a little bit of help. But as stated, the fees are still going to be higher for these more at-risk buyers than they are for those with good credit. And trust me, from someone who had to build their credit up, building credit is not easy. It is easier to get it down, but good luck bringing it back up. But there might be a way to lower these fees for you. And now this is something called recasting your loan. Now, I am not a mortgage professional. I am not your loan officer. Everyone's situation is different. I highly suggest you triple check with your loan officer that this is a possible scenario for you. And here's how it would work. So instead of putting your 20% down, let's say you get your loan and you put 5% down. Now, after a few months, you pay a few mortgage payments, then you go and you request a recast of your loan for that extra 15%. Now, what is a recast? Now, you're not just putting it towards the principal. Basically, you are giving your bank a large sum of money, and in return, they will lower your loan balance and your payment amount, keeping your same mortgage rate. And because this isn't a refinance, your loan term limit stays the same. So if you did this 5 years down the line, you would still have 25 years left on your loan. It wouldn't bump it back up to a 30-year loan again. Again, this is a special case scenario, so make sure it does work for you. But I'd love to know in the comments, let me know your thoughts about this. Is it a good idea? Is it a bad idea? What are the implications gonna be? And I will see you on this video right here.